Hey, what is going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and today's video is going to be insane. We're going to be taking a look at how adjustable rate mortgages are becoming popular again, and we're going to try to find out whether or not this is going to lead to another 2008 style housing market crash. Now, if you are new to the channel and you like all things finance, real estate, and investing, please consider hitting that like button and that subscribe button right there. And if you haven't done so in the past, please consider leaving a comment. It really helps me learn and grow, as well as helps others learn and grow. Without further ado, let's jump right into this article and find out the details. All right, so up on the screen, I have an article from CNBC. I'll go ahead and link to it in the show notes, but it says that adjustable rate mortgage demand surges to a 14-year high. Personally, I'm pretty surprised by this because it is something that got us into some trouble back in 2005, 2006, and 2007. Now, it says, as homebuyers try to afford this pricey spring market. That's obviously true. Interest rates are up quite a bit, and home prices have not really rolled over, even though in some pockets we're starting to see some price decreases. So let's go ahead and jump right into it. It says that it could be more listings on the market, or perhaps just fear that interest rates will move even higher. But home buyers are showing more demand for mortgages. They are, however, turning even more to adjustable rate mortgages, or ARMs, which offer lower rates. That gives them an advantage as both rates and home prices continue to climb. Okay, that is absolutely true. But again, it is an adjustable rate mortgage, which means it is fixed for a period of time and then it can adjust based on the market after that. So in my view, it's kind of risky. But of course, personal finance is personal, so everybody has to make that decision for themselves. Article goes on to say that mortgage applications to purchase a home rose 5% last week compared to the previous week. So we are starting to see more people applying for mortgages, and most likely they're making more offers on properties, especially as competition cools down a little bit. It says here that demand was still 8% lower than the same week 1 year ago, but that annual drop is now shrinking. So it says that the mortgage rates increased to 5.53%, and that is up from 5.36%, with points rising to 0.73 from 0.63. So that's, in other words, the cost in order to secure that rate. It's a fee structure. It's based on the actual loan size itself. So if you have a $100,000 loan, it would cost you $730 in points in that case to secure that rate of 5.53. That's what they're talking about. Now, it says that the rate on a 5-year adjustable rate mortgage was just 4.47%. So in that case, it's actually a full percentage point lower than the average 30-year fixed conforming rate, which is obviously going to help affordability. Now, the article goes on to say that despite a slow start to this year's spring home buying season, prospective buyers are showing some resiliency to the higher rates. Purchase activity has now increased for 2 straight weeks. More borrowers continue to utilize ARMs to combat higher interest rates. The share of adjustable rate mortgages increased to 11% of overall loans and to 19% by dollar volume. Now, I was pretty surprised to hear that nearly 1 out of every 10 loans being originated is an adjustable rate mortgage. Now, as I mentioned, there is a time and a place to take an adjustable rate mortgage. For me personally, that would not be right now, unless maybe I knew I was going to sell a property within a few short years, and maybe I had a really, really large equity position, like maybe a 50% loan to value or better. But if I didn't have one of those things, I don't know that I would be inclined to go with that adjustable rate mortgage. Having a fixed rate mortgage really helps me sleep at night, and that's just me personally. It's not financial advice. Now, the article goes on to say that at the start of the year, when rates were still hovering at near record lows, the adjustable rate mortgage share was only 3% of purchase applications. At 11%, that is the highest we have seen since March of 2008. So that's the highest share of adjustable rate mortgage we've seen since the great financial crisis. Now, as we continue, this article describes what an adjustable rate mortgage really is. So the ARMs offer lower rates, which can be fixed for terms like 5, 7, or 10 years. ARMs are fully underwritten like fixed rate mortgages, and they do require a down payment. This was not the case in the early 2000s when poorly underwritten interest-only ARMs with short teaser periods were blamed for the epic housing crash. So that is true to their point here. These adjustable rate mortgage products that are available today, in most cases, they are fully amortized, meaning they are principal and interest. And the mortgage underwriters are qualifying you based on that actual note rate as opposed to a teaser rate or a very low entry level rate. And on top of that, these rates are fixed for at least 5 years in most cases. So 5 years, 7 years, or 10 years, and then they can adjust based on the market after that. But, for me personally, we are in an inflationary environment. The Fed is talking about continuing to raise interest rates. So all signs are pointing towards maybe higher interest rates in the future. If that's true, there will come a point where these adjustable rate mortgages, they will need to adjust, and it will just depend on what the market looks like at that time. Now, in wrapping up the article, it says that while home buyers are showing more interest, current home owners have less interest in refinancing. Those applications dropped another 2% week to week and were 72% lower than a year ago. There is simply a very small pool of borrowers left who can benefit from a refinance at current interest rates. Yeah, so this is absolutely true. I mean, refinancing fell off a cliff, at least the amount of applications, because interest rates have gone up so much. And in order to refinance, you really just need a benefit. You either need to lower your rate, lower your payment, reduce the term and pay the balance off faster, or maybe you're in a position where you want to take some cash out, pay off some debt, or maybe do some renovations and repairs to the property. But I read this statistic more recently that said, I think 80% of all households that have a mortgage are well under the market rate. I think they cited somewhere around 3.5% or less. So if you have rates today at 5.5%, even if you want to do some debt consolidation or some renovations to your house, you're certainly going to be thinking twice about pulling cash out and restructuring the debt in its entirety, because you're going to see a really huge payment shock from where you are today. Now, these adjustable rate mortgages, I am really surprised to see the upswing here. Obviously, in the short term, it does create more affordability. And if rates go down in the future, maybe there'll be some potential to refinance. But I do think, and of course, this is my personal view, I think you're playing with fire a little bit here. Because we are in that inflationary environment. We are being told that rates are going to go up. So in my view, I think most home buyers, they would benefit from just a normal, traditional 30-year fixed rate mortgage. They know what their payment is going to be. It'll help them sleep better at night. But again, that's just my personal opinion. But if you are going to take an adjustable rate mortgage, absolutely, I would try to have a really strong equity position and then just know what your game plan is when that mortgage is set to adjust. Anyway, based on the actual fundamentals alone and the fact that the underwriters are qualifying folks based on the fully amortized rates, not interest only, and they are requiring a substantial amount down in order to qualify for these loans, I don't think that these adjustable rate mortgages are ultimately going to lead to a 2008 style housing crash. But only time will tell. We'll have to see where the market goes, what rates do here in the coming months and coming years. That is all I have for you here today. I hope you enjoyed the video and found value in it. Please, if you haven't done so already, please consider liking, subscribing. See you next time.